Good morning to all. We are happy and thankful, actually, to welcome Jacob GYNTELBERG for a session on the 2023 bank stress test organized by the EBA. Jacob is the director of the Economic and Risk Analysis Department of the EBA, which is in charge of the analysis of risks and vulnerabilities of the EU banking sector, in charge of impact assessment of regulatory measures, and in charge as well of ESG-related activities across EBA, which is a topic in itself. Jacob is an economist with extensive experience in prominent economic and regulatory position in both the private sector. I know especially Danske Banks and Nordea, and as a regulator in Denmark National Bank for International Settlements, and for 2 years now in the EBA. Jacob will comment on the results of the bank stress test published at the end of July. The objectives of these stress tests, Jacob will recall, is to assess the resilience of the EU bank to severe shocks and to determine appropriate mitigating actions if there is a need for it and for them, and we will be discussing that. So the results of the stress test are actually rather comforting. EU banks remain resilient under an adverse scenario, and despite combined loss of close to 500 billion euros in the adverse scenario, well, the situation remains good for the banking sector as a whole, and the banking sector remains sufficiently capitalized to continue to support the economy with a CET ratio still about 10% on average. And only 3 banks actually fall under the total SREP capital required. However, as it is mentioned in the assessment, there is need to remain quite vigilant. You stress in the reports the high impact of credit losses, especially, and so there is need for a discussion. So we will discuss with Jacob about some aspects of the methodology to be sure that we all understand the same thing. Discuss the results and the lessons learned by the EBA, but also national authorities and ECB and banks as well, and discuss about any further regulatory action to be considered, and we will also discussing about the upcoming Basel III regulation and the justification for going a bit further in terms of requirements. So we will also discuss maybe the short comparison with stress test exercise done in other jurisdictions. You may be willing to provide a consolidated view on the banking sector in the EU and maybe the current challenges of the banking sector. And we will have also, maybe if you will, some discussion about climate risk, which was not really part of the report here. But I know that there is a Fit for 55 scenario analysis that will be launched at the end of this year. So, Jacob, thanks again for being there, and happy to hear your presentation about this stress test. Thank you very much.
Thank you very much, and thanks for having me. This is I know that you think it's not useful for me, but it is. It's super useful for me to hear a bit of pushback, have some good questions and dialogue, because it's an ongoing process, right? So thanks for inviting me. Now, let me say 2 things before I dig into the details, right? So I'm happy to take any question. I may not be able to answer all of them, but just shoot, it's fine. If I don't know, I'll say I don't know. I don't have a problem with that. So please don't be shy, yeah? And it goes for the people online as well. Just put it in the chat. I'm sure we'll figure out how to field the questions, yeah? Now, if I do this, How do I do this? How do I move down?
This no. So you will have to scroll down then.
I have to scroll. Like, here we go. So, just to recap, right? We have for the first time in a long time, we've had a proper change in the macroeconomic situation in Europe, where we've gone from say very low rates for a very long period of time post the financial crisis to a rising rates environment, and I would say a bit more geopolitical uncertainty, and certainly some real economic changes post a pandemic, which makes this a slightly more complex environment to operate in, right? So I would say, as was said, look, banks come out okay. Banks have a lot more capital today than they did when this thing began. So part of the journey that we're on is also just that, look, bank capital has basically tripled since the financial crisis in Europe, and not just in Europe, but elsewhere. So the regulatory insistence on more capital is definitely part of the explanation for the outcome we had. Yeah. If I look at how severe the scenario is and what happens to the banks, it's a pretty severe scenario. It's probably the most conservative scenario, the most severe we've had in a long time. It has a very different flavor from the last rounds, right? So it's high rates, high unemployment, lower growth, much lower growth actually than in the past. And there are higher commodity prices, and there's substantial falls in real estate prices, and the list goes on, right? So despite that, it's only sort of 4 or 5% decline in the CET1 ratio on average. Some banks take more of a hit, some banks less. But at the end of the day, right, with a very, very conservative scenario, quite severe assumptions, it is comforting that the banks end up holding, not 15%, but 10% in capital ratios, which means they should be able to service the real economy, even in a quite bad economic outcome. And again, we're putting in almost $500 billion in losses, mostly due to credit risk, but still it's $500 billion, right? So again, it's not peanuts that we assume the banks lose in this exercise. Yeah. Now, obviously, as my role here is to be the cautionary dude, it's clear that the macroeconomic outlook remains a bit more complicated. So I would say, as some of you who sit in banks know, this is not the same as saying, yeah, then all is well, we can go back to whatever we did before. Right? It is going to be a challenging next 2 or 3 years, and there's plenty of uncertainty around. So no rest for the wicked. Yeah. If I take a step back and say, what have we done differently this time around? We've added a lot more banks, so we've gone from 50 to 70. Under the hood of that number is that we've kicked out a number of government-owned banks, what I would call the special projects banks that we really don't need to look at, I think, from our perspective. So we now have more or less 70 real banks. Maybe there's a few stragglers on the government-owned bank side that you can debate whether or not they actually ought to be in the sample. But mostly we've added quote unquote privately owned real banks, so to speak. And we are now covering countries we didn't cover before, most notably Greece. So we had no Greek banks in the previous stress test. I think that's one. The other main thing we've done is we've now introduced a top-down model for net fee and commission income. This is a collaboration between us, the ECB, and all the other competent authorities to try and let's say bring it back from being bottom up to a more centralized exercise. We have also added a bit more nuance on the sectoral composition of banks' assets. Again, this is clearly a lesson partly driven by COVID, partly driven by a desire to start teaching the banks how to give us information that we're going to need for climate stress testing. Yeah. So there's a hidden agenda somewhere in the works here, right? A few other things we've done. We've made the pass-through assumptions on deposits a little bit less severe. They used to be 100%. We made that 75 and 50% pass-through rates. That's still quite conservative, we know, but it's at least a little bit more reasonable than we did before. We've made the handling of securitizations a little bit more realistic. So that's also a little bit less aggressive than it was in previous stress tests. Yeah. And there's a few other bits and bobs on the detail side that I won't comment on. And last but not least, we have a special treatment for the end of the sort of special funding from central banks. Right here, we've allowed the banks participating to net out the ECB deposits with the loans from ECBs to make it a little bit more reasonable. So this is, I mean, clearly a special situation given special circumstances. The other thing we did is we added the memorandum information on the shift from IFRS 4 to 17 to demonstrate that for those bank assurance groups that are out there, that change in accounting rules does have a clear impact on the losses they see. Right, so there's a couple of banks where this really makes a big difference. So that is also, I think, just to be fair, right? My SSM colleagues always want me to say that this hasn't been subject to the same quality assurance as the other numbers, but still, I think it's a good thing that we included those extra numbers because they do give that nuance so that people see that that is a non-trivial accounting rule change for some banks. Yeah. If I take a step back again and look at the entry point for the banks, as you can see, high capital ratios, as I comment on, but also quite low NPL ratios post-COVID with substantial fiscal stimulus. But as you can see from the chart in the middle, it's been a general trend since the crisis that the quality of assets seems to have been improving gradually in the bank, right? So it's not just a policy stimulus thing. It really is that the quality of assets seems to have been improving and that the NPL levels have gone down for European banks, right? Some of that is that banks have sold off bad debt. That's fine. That still means that the asset quality on the bank's balance sheet is improved, right? So all of that is fair game, but it is a trend. So that is also, I think, something one should keep in mind. If we look at the return on equity, as you can see, sort of average numbers have been going up a little bit, right? It's still not the case that European banks' profitability is overwhelming when you compare to other parts of the world, but it's at least better than it was post-crisis and certainly during the COVID period, right? So again, a reasonably level of profitability that helps the outcome as well. Just to keep that in mind, yeah. Here we go, right? Again, just to show the outcome here, the point I'd like to draw your attention to on this slide is that we have a baseline scenario and an adverse scenario, right? So the yellow bars and the greenish blue bars, I hope demonstrate very clearly that there is quite a bit of difference between the baseline scenario, which is sort of a normal, very positive scenario, but a normal growth scenario with income and retained earnings and a gradual buildup of capital, right? Again, remember, we assume a constant balance sheet. So this kind of scenario, banks just pile on to the capital, really, because we tell them that's what we force them to as part of the exercise. They're not allowed to deploy, right? But just to make it clear that the baseline and the average are very different. Yeah, it's quite a bit of gap between the normal times and the adverse scenario in the exercise. Yeah. As you can see, actually, it's almost 150 basis points increase in the CET1 ratio under the baseline, where things just run and nothing bad happens. Yeah. So the gap is really substantial. On the scenario, just to remind people, I said low growth, but just to make it clear, it's a 6% drop in GDP cumulative over the 3 years. So that's basically 3 years of recession. And just to compare to current times, right? We're still debating whether there's actually a recession coming in the second half of this year. And there was debates of if we really actually had a recession during the pandemic, right? So 3 years of actual recession is a very conservative assumption. On the rate side, again, as you can see, I put in the middle panel there, I put 2018 and 2021 rate paths for comparison with what we do this time around. As you can see, it's quite a different story that we're telling this time around. But before it was a little lower, longer, flat, or no increases in rates. Now it really is a jump up. And actually the scenario is still ahead of and more severe in terms of rate increases than what's happened in real life. Yeah. So we're still ahead of the ECB a little bit. We'll see next week what happens, right? On the inflation side, again, a notably different picture, right? You can see basically borderline zero inflation in the previous stress test. This time around, we're off at cumulative 20% inflation, so that's 6 to 7% per year. That again, given the last 10 years, a somewhat different a different story. Yeah. There we go. Right. So, what are the main drivers of the results? I think here, for me, it's on the positive side, it's net interest income, and a bit more on commissions, right? That helps. On the negative side, it's cost basically, and then it is the credit losses. Then it's a little bit of market and a little bit of op risk, but they are not the main story in this narrative, right? So you can. I mean, again, you can see. I mean, I'm just going to say market risk. I'll get back to that. Op risk is always a bit of a. You can make out pretty much whatever number you want, right? We try to base it on what we have in terms of facts from the banks. Banks seem fairly optimistic that there won't be major op risk losses. So that's we've been a little bit more conservative, but still, op risk is not seen as the main concern here. On the structure of the losses for credit risk, which is the big one, right? You can see again, baseline a lot more benign than the adverse scenario. And it's a structure where the losses are highest in this year, and then they sort of go down overall, right? But as you can see, it's roughly sort of 350 billion in credit risk losses, which is a sizable number. Loss rates are a little bit lower in this stress test compared to the one before, despite the severe scenario, which to my mind, what we've seen is that seems to be a combination of pretty much unchanged sensitivities, but a better starting, right? So it's not that the bank's models or the way that this has been calculated looks materially different, right? It is just mostly a better starting point with a more severe scenario, and it comes out more or less the same. Right? Again, this is not a science exercise. So on the sector side, I think here for me, it's about the housing people, right? So it's accommodation and food services that takes a hit. It's construction, and it's the energy intensive sectors that seem to take a big hit. So that fits sort of roughly what you would expect, right? Given that we've got severe declines in both real estate and commercial real estate prices. We have high commodity prices, including energy prices. So it'd be odd if that didn't come through, right? Again, to be fair to everyone here, we know that it's very difficult to do sector models. We know that many banks don't do it because of that. It has been a significant piece of work also for the ECB colleagues to work on this, try and get a better sense. But I think the signal from my side is please continue working, because this is going to be important for the climate stress test work we're going to do down the line. Yeah. And that is going to be the expectation, I can say, with my other slightly more green hat on. Yeah. Well, if right. So the main point here is Why is the net interest income such a big positive? Well, banks make more money when rates go up. What that means is basically the banking is not just a spread business, putting it simple, right? It's a combination of a spread business and a markup pricing model. So when rates go up, the markup pricing business does better, so net interest income goes up. Now, for me, the important thing to highlight is that here we're being kind of rough on the funding costs as well, right? We're being conservative, but NII goes up nevertheless. So banks are paying higher funding costs in this exercise. They don't get away with not remunerating deposits and not remunerating their bondholders, right? So here the stress test is a lot more conservative than reality is, as you all know. Deposit markets, at least what we seem to see right now, are a combination of markets with some pricing power by banks and a low demand, a low price elasticity by consumers, right? And elasticity is a bit higher for the corporates, but even for the medium and small corporates, elasticity in terms of moving your deposits around to get a high yield is low, right? There is an element of bundling of services. You don't just change your house bank as a company. So the deposit market is, you can see that right now, is maybe not as contested as one would think, right? Again, I'm going to say this openly, I'm not so surprised. I know that this is a political thorn in the side of some people, depending on where you are in your leanings, right? So this is a live debate in a number of European countries where there's frustration on this point, yeah. But in the stress test, that feature is not there. It is priced in, there is movement, it is taken into account, right?
Excuse me, what I should say that actually well, the increase in interest rate has a limited impact on the value of banking assets, and the liquidity assets.
I'm going to come back to that particular point, but I will say this: the pass through from higher rates to deposits is a lot lower in real life, it seems, than what we assume in the stress test. Significantly lower, right? And again, the pass through to bond pricing seems again to be less pronounced in real life than it is in the stress test. Yeah. And I'll come back to that at the end because I have a few other comments on that particular point, right? Now, second point is that we understand, and I think this is a challenge for us as well as for the participating banks. We do understand the European banking market looks very different, right? At one end of the spectrum, you have the French banking market, the German banking market, which is more fixed rate. At the other end of the scale, you probably have Spain and Italy, which is more floating rate. So what you also see is that depending on how your balance sheet is structured in terms of your reset frequency, that comes across quite clearly in the stress test. Yeah. Now, one might say that's unfair. My bittersweet comment is, yeah, but the ones that are fixed rates also benefited in the others in the previous stress test, right? So now it's the floating rate banks term to have a little bit of extra plus, but it is what it is, right? It is a reflection of the balance sheets of the banks. It's not something that we make up, right? But it is a feature, right? It's not a bug. It is a feature, and it's fair enough, right? I mean, now moving on. So the new element is that we've taken the net fee and commission income and taken that out of the hands of the banks and into the hands of the supervisors and the regulators. Two reasons for that. A, this is to be fair to the banks, this wasn't maybe the strongest modeling area in many banks. To be honest, in terms of forecasting ability and how the models are, it wasn't very good. Some banks probably are okay, but a number of banks were definitely not okay in modeling this. This is a difficult exercise to do a top-down model that captures the dispersion across the European banking system in terms of where you make your net fee and commission income. So what has been done is to have the ECB SSM conglomerate has a model. That model has been updated and improved and validated quite aggressively by among others, me and my colleagues, right? So there's been a band of other authorities double checking the model. So we changed the model and improved it a little bit. Is it a perfect model? No. Is there room for improvement? Yes. But does it meet sort of normal validation standards for a model? Absolutely. Yeah. And it does okay at forecasting, and it has sensitivities that are a lot more credible than what the banks themselves have. So does that mean that it'll fit excellently for every bank? No. Right? Does it mean that it's within a reasonable level of tolerance? Yes. The cynical comment from my side is also the numbers here are small. The NFCR numbers don't make up the bulk of the bank's earnings. So it's also a low impact testing ground for top down, right? And I'll come back to some of the lessons here, but let's say it's clear that to do top down in the other areas, more work is going to be needed, and we need to think more carefully, right? This is going to be hard if we want to capture the heterogeneity in the European banking system to go top down. But so there you go. Again, quite a bit of difference between the baseline and the adverse here, as you can see. Market risk, here the exercise is slightly different. It's a big bang in the first year, you take a big hit, and then you get to recover, right? So if you look at the left-hand panel, you can see a big orange bar that goes down, and then you have two small orange bars that are on the plus side. So you lose about 140 billion, 160 basis points year one, and then you get to recover around 40 billion the following 2 years. So net, right? It's a little over 100 bips in the CET1 ratio in terms of losses. Yeah. So again, a big number, but not the main driver. Yeah. And that's been the same for all the stress tests. Again, this time around, the impact's bigger because the movements in rates and in market conditions across the whole spectrum of financial market assets was bigger, right? More aggressive scenario. If I move on, if we get here, operational risk losses again. It's 50 billion. Right? Not a lot of money in terms of op risk, in terms of what you could imagine. I think you could choose a number here. It's a bit like a lotto game, right? So I don't think there's any truth. So this is not where the severity lies. And this reflects input from the banks, who seem pretty confident that they won't have major IT upsets. They won't have any major compliance type fine, whatever conduct driven losses, right? In terms of the loss composition, it's partly just good old fashioned mistakes. And the other half is conduct, fines, getting it wrong, mis-selling, whatnot, yeah. And this is based on the bank's input. The last thing, which is always a bit murky, but just to remind people, when we change the conditions, you also change the risk-weighted assets, right? You make the world look more gloomy, you get higher risk weights, that means the risk-weighted assets go up, and that is a driver of a capital requirement. And so this is the little extra round that we have. As you can see, it's sort of a 13.8% increase in risk-weighted assets. So again, it counts in terms of driving up capital requirements, but it's not a huge number. But it is there, right? It's also not zero. Yeah. And this is again mostly due to higher risk weights for credit risk. Yeah. So it's not so much, you know, we're not really assuming that the market risk models are off and you get your add-ons and the market risk capital requirements take a hit, right? So if I wanted to be more prudent, I could add a bit of punishment there and say, well, we're going to assume you get it wrong and your models won't hold. So we're going to have to ding you on the market risk side as well for capital requirements. That's not part of the soup here. Yeah. Just to make that clear. So it's all credit risk, or mostly credit risk, as you can see that. So here are non sort of the, as you will know, most of you here, we put out an abundance of data from the exercise, right? So we cover all of the 70 banks, right? Mostly SSM. but there's also a sizable non-SSM component, right? So the Nordics and some of the Eastern countries are there, right? So they also count. We are debating, to those of you who've been agonizing over making sense of the data, we are debating how to release the templates for each bank, but without all the nitty-gritty details in the back, right? So we are going to try to improve the bank by bank availability of data to save the analysts, the poor analysts, a bit of time and effort here, right? I think we've been told in no uncertain terms that that's probably an area we can improve. So we're working on that as we speak. If I get my way, we'll do something before the end of the year, put it out just for service, right? So we'll see. Here, boom. In terms of what we deliver, again, a fancy report, some slides. There's a visualization tool on our webpage. We have published PDF versions of the individual transparency templates. That's the ones I would like to make available in a more data scientist friendly format. And then we have the entire data sets we put out in very large CSV files, right? So all of the stuff we get in more or less, we share. There's a few bits and bobs we don't share because that will be unfair to the banks, right? Now, before I end, so the one thing I haven't said much about, but that comes to the question which was asked, alongside the stress test, we did an extra little ad hoc data collection on bond holdings because there was this debate following some of the things we saw in the US as to the losses on bond portfolios of banks, right? So there was this notion that, oh, maybe the European banks have lost a lot of money on their bond portfolios. Again, I think the answer is not really, right? Because actually, just in raw terms, the group of banks here holds a little over 2.2 trillion in bonds at the point of entry into the stress test, and they lost roughly 5.5% of that in terms of losses, right? So again, not peanuts. So 140 billion when you take into account direct hedging. So again, some banks more than others, right? But not in any way close to what you've seen in the US banking system.
It's just in that the accounting of bonds have an impact on those results. I mean, if you open to maturity, actually, eventually that means that actually you don't account for any loss in value, except if you go to on the market to sell them. But actually, if you hold them in available for sale, but precisely where you account for this.
Right. So this is a philosophy question, right? I mean, I don't have an answer. I mean, in the stress test, we behave inside the accounting rules. If you book your bonds as hold to maturity, you're not supposed to register the losses and take them out of your P&L, right? So we don't do that. But the reason we added that is to make it clear. Look, imagine you had done that, right? In the extreme case, imagine all bonds have been at fair value or available for sale. What would it look like, right? I don't think, to be clear, I don't think that it is a natural thing to say, oh, banks must hold all banks at fair value, right? I think that would be an odd restriction on the banks. I just don't, and there's no appetite for that, as best I can tell. I think where the rubber hits the road from a sort of prudential regulatory aspect is on the liquidity side, right? Today, we allow banks to include the value of amortized cost holding bonds in the liquidity portfolio, but they're allowed to include them only at fair value, right? The question is, how large a share of your liquidity buffer should you be allowed to have at amortized cost? That's where the debate has always been, right? So supervisors couldn't agree back in Basel I. They didn't agree in Basel II. They sure as hell didn't agree in Basel III, and the disagreement stands. Yeah. Just one last thing. And the thing is, a number of supervisors are now saying, look, okay, we can live with maybe up to 5, 10, 15% of your liquidity buffer being an amortized cost, but not more. Anything more than that, we want you to hold extra capital or more liquidity, you can choose. That's the dialogue that's taking place as we speak, right? Please.
Just to return something what you just said, at SVN accounted for their bond portfolio at fair value, maybe they would have been made clear much earlier than they were out of capital and at risk.
For sure, right? I think if you looked at the books like some of us did, they were basically insolvent by the end of the year. Yeah. Now, could they have been caught early in the net in terms of discovering this? Absolutely. Had they been subject to a stress test, which they were not, this would have come up pretty quickly. Yeah. I mean, so I think that's also one of the lessons the Fed is drawing out of this, right? So, we should probably, move a step closer to what the Europeans have been doing, namely subjecting all banks to stress testing, all banks to liquidity requirements, and all banks to the NSFR requirements, right? So I think the Fed report is out. I'm just repeating what they are saying themselves, that this is clearly something where the mid-sized banks in the US are probably best served by being subject to the same type of rules as the big banks, sort of more or less, maybe, minus 10%, but basically the same package. Yeah.
It's 250 billion. It's not mid-sized bank.
No, but look, the fact remains, and I guess, we've been having this discussion at my table for a while. It's clear that if you raise rates 200-300 basis points, right? Observation number one. Observation number two is you've told banks to hold 10% of their balance sheet in bonds or cash equivalent assets. That's right. Then you would expect that, and you've had 0 rates or very low rates. So the incentive to try and get some interest income without measuring the market value of the bonds has been strong for the banks, right? I mean, it doesn't take a genius to figure this out. That means that when you then raise rates, this is a legitimate concern, right? I mean, we did an analysis well before the stress test to look at this, because we were thinking, okay, let's just make sure that where are the banks? What does it look like, right? I mean, it looks okay in Europe, right? Banks hold less bonds than you might think, but they are still holding sort of 2.5, 3 trillion in bonds, right? Just to be clear. But of course, right, if you raise rates, you have what, 20 trillion in bonds in Europe, 25. You do the math, which one's the one you want to include? 5 are held by central banks, maybe a little bit more, right? 3 are held by banks. That leaves 17 trillion, 15, depending on your flavor. Somebody's holding those bonds. So the losses sit somewhere. And the same is true for the US, right?
Probably maturity of bonds. If you look at what happened with the Silicon Valley Bank, for example, the bond portfolio was really because of long-term bonds, more than for 10 years. And there was no hedging on.
I agree. But here's the rub, right? If you have to
price more easy.
No, point taken. I mean, look, the 20 trillion in bonds, whatever it is, I mean, the average maturity is somewhere around 3 to 5, right? So there is a loss, right?
Yeah, probably more limited than if you hold 10 years maturity bond.
No, I agree. But then again, when you say hedge, for me at the system level, that means that somebody else holds the bag, right? So the value of the assets will be affected. Then the question is, where does the loss sit? I mean, if it's spread out and it's well managed and it sits in with people who don't have to sell the bonds and realize the loss, we're probably okay. That's part of the debate we're having with the banking industry now. You're holding these bonds. What's the risk that you will have to realize the loss? Well, I mean, I don't have the answer, but that is the relevant debate, right? It is the same debate to be had with pension funds, insurance companies, and anyone else who's been doing this activity, right? There are also crypto issuers that hold bonds. Right? You will notice that the value of crypto assets has gone down, pretty reflective of the value of the underlying bonds, right? So again, the loss is there. It's just a matter of, is it going to cause a problem, or is it something we can absorb and move on, right? And again, moving from 0 to 300, in a very short period of time, this is what happens, right? I mean, my other concern, quite frankly, is sitting at my table is, are people ready for this? We've had 10 years of flat zero rates. There's a whole generation of old people who left the industry, retired. And what we have left in the risk management departments and at the trading floors is a new generation that never seen stuff like this, right? So is the culture there, is the capability and the infrastructure there in the system? And that includes my side of the table, right? I mean, I've been giving talks about the 70s and the 80s to my staff to remind them of history here. So, I mean, and I think this is a legitimate question, right? Are you up to snuff when you're looking at the situation we're in, right? We're going to have lower rates at some point, probably, right? So there's another movement coming the other way, yeah. So let me maybe say a little bit about the future. So on the future, we are looking to do more top-down. The discussion we're having is how to do it in a way that is reflective of the heterogeneity of the EU banking system, so we don't end up in what I will call a bad equilibrium with a cookie cutter approach that we take that makes it less useful and less informative from a sort of both a prudential but also systemic stability perspective, right? We'd like to do something which is meaningful and is hopefully a little bit less burdensome in terms of effort for the banks, but certainly also for the supervisor, right? The supervisory effort in the bottom up is massive, right? So a lot of people, a lot of man hours. The question is it really worth the effort given where we are? Or is there more value in having a credible top-down approach where we can be a bit more agile? So we don't have to have a 6-month debate about the scenarios, then another 6 months when we do the exercise and then we have the results, right? Might we move a bit faster? Might we have one every year? And then on occasion do a bottom up, right? So combinations of that is also a possibility, right? So we are, to answer a question that was asked before the seminar, we are going to reach out and have conversations with the banks and industry and others on how to do this. We're having conversations with the competent authorities, and we're talking with, let's call them clever economists and people, the more nerdy types that know how to build these things from top down, right? So we're all looking for technology to do this. Yeah. Ideally, I would like a setup that we run that can do both a standard prudential stress test, and we can use the same infrastructure technology to do climate stress testing as well, right? That's again part of when we go out and ask for data, which will be part of the new regime that will ask for more data. In return, you won't have to have the models, right, as banks, right? So this is the trade-off we have to debate as well. We ask for data, we put them into a machine that can hopefully do different things, right, with different uses of the technology. But that's the conversation we're going to have, right? And again, I'm in the market for good ideas. I can tell you it's not an easy exercise to accommodate what is de facto 250 banks in Europe that look very different, to do something that makes sense and is sufficiently, resource consuming, not too resource consuming, right? So we're going to have that debate, and there will be invitations. But if you have ideas, I'm only an email away. I'm going to put it like this.
That leads me to a question. How do you ensure that what's the level of confidence on the reports that you are being submitted? Because the thing is, in my role, I'm providing solutions to some of the banks. Some of my clients have been in the past dealing with a number of issues in terms of aggregating the data, struggling to provide these reports.
Yeah.
And sometimes they just push the reports out of the door last minute because they were not provided with the right tools, etc., etc. So my question is, when you do receive those reports, do you help them in controlling the quality of the data? Because it's going to relate to what you're going to come up with in the climate risk issue. So you have to. So what's your view? Sorry, it's a very generous.
No, I understand, right? So So the deal is that today it's the national competent authorities that are supposed to quality issue the data, right? So the EBA does look at the quality of the data. In my other role as doing the risk work for the EBA, looking at what's going to happen and what might be good and what might be less good, I think it's fair to say I'm not overwhelmed by the quality of the reports, to be honest about it. Right? I mean, look, I'll give you one example that came up during this recent period when we were discussing bonds and mark-to-market and non-mark-to-market holdings and whatnot. Right? A good chunk of the banks have put in the same number under mark-to-market and non-mark-to-market. Right? I'm just like, wow. You know, I could be nice about it. I don't really feel like being nice. I think that is just not good enough, right? So there is room for improvement. I think that recognition is there also in the national competent authorities. So for sure, we're going to have to do better collectively in figuring out how to get good quality data in so we can actually do a proper piece of work, right? The ad hoc exercise was also a challenge for a number of banks, right? I think we had, I mean, the in-house joke for me was, you were expecting to ask once, you should expect to ask 5 times before you have a reply you actually believe. Now, my 5 was a little bit high. The average number of submissions just to tell us what are the bonds you have, what's the value, what's the maturity, was 3 attempts for each bank, and these are the large banks in Europe. To me, that's not a win for the industry, nor for us. So I think my SSM colleagues would agree that this was more painful than it had to be. Yeah. So I think we are going to have to find a way to do better, right? And you're absolutely right. If we're going to go top down and we're going to have to ask for more data, to do this, we are going to have to find a way to make this work. And it's okay today, but it's not great.
One of the difficulties for the bonds were that you asked for dates which were not 31st of December, or even the quarterly end dates. I think that was one of the difficulties, I'm sure, for a number of banks that would also be. Is it something that made you think of it and give up during the end of months instead of before? Absolutely.
I mean, I immediately said, look, can we please not ask off schedule? Because I know, no, it's important that we get them for February. Okay. So my suspicions were obviously proven right. Now, there's 2 ways to look at this, right? Again, I don't think it's an unreasonable expectation to ask a big bank to be able to deliver this end of month for any given month of the year. I mean, I understand that there's more due diligence when you do the quarterly reporting, this whole process at a big bank. But we're only asking about bond holdings, right? It's not exactly, can you please give me your balance sheet in February, right? That would have been completely unreasonable. So I'm also a bit torn between accepting the notion that the large banks can't actually deliver the data pretty easily for their bond holdings. I would have thought, especially in a period like the one we have now, I would have expected that there would be a lot of treasury people out there going, yeah, I have it right here. I have it every week on my AML committee meeting on my ALCO, because my board wants to know how much money I'm losing on my bond holdings. If I've hedged, you know, am I in command? What about the next 200 basis points I might be worried about from the ECB, right? So you can hear from the way I'm saying this, we were not impressed, right? Just to be clear. So there is a task. And again, how to solve it, I don't know. I mean, it's a resource question, but it's also, I think, a conversation question. My sense is that we need to have a conversation about what's the cut you take into the bank's balance sheet when we ask for the data versus what the banks themselves use, right? If we ask for stuff with a very different cut, then obviously we're asking the banks to do things twice, right? So part of it is also for us, I think, to recognize that, okay, maybe we can look at a different cut of the data and what we ask for, and that might facilitate some of the the reporting and make it less painful and better quality, right? But that's a conversation we need to have. I mean, given the amount of data we get in right now, I mean, it's not going to be a small thing to change and modify, right? Because it's hard coded in now. There's standard processes running in all the banks. So for me, just to say, yeah, let's change all that and tear that up and go again, is also not a viable path, right? So we have to find a way to make this work. But it will change, I'm sure. That's also why I'm saying it out loud, giving you heads up, right? Fair warning.
In terms of methodology, still, Jacob, do you some lessons to be taken also from the same exercise done in other jurisdictions? Are there things that they're doing better than we do in terms of calibrating, or in terms of frequency, in terms of data as to the industry? Are there good lessons to get from the US or the UK? Or
If there is a point that I think is worth having a debate about, it is that the UK version has a bit more dynamic balance sheet adjustment in it. The question is, if we go top down, could we add some of that to the soup so we get some of the adjustments in that seem reasonable? Challenge right now, of course, is that saying allowing the banks to adjust, we will get completely unrealistic adjustments, I think, is the concern from the supervisor side, right? And then it loses its supervisory value. So we need to find a balance, but I think that adjustment room, that adjustment question is going to be a live one. And certainly if we're going to do climate stress testing, which has a longer time horizon, we are going to have to find a way to allow for balance sheet adjustments in the stress testing approach. Or else it's not, I mean, it won't make any sense, right? If I do a 30-year scenario analysis based on NGFS scenarios, and I assume that all banks hold constant balance sheets, I mean, people are going to shake their heads with good reason, right? So I think here we're going to have to figure out how to become better. I think it's my main point, right? I think the other aspect is obviously that we're being very transparent in the EU setup compared to what the Fed does, right? That's a choice. So the question for us is, what do we do when if we go top down, how do we address the transparency issue, right? There's going to be a debate, right? Where again, you will have two camps always, right? You will have the hardliners that don't want to share anything. You just want to say it's going to be like the Fed, you get very limited transparency. That's it. So we're not going to tell you much about the models or the approach. You're just going to have to suck it up. Others will say, yeah, maybe that's not super healthy, because actually it's good to subject yourself to the peer review that's implicit in the transparency, right? But that is going to be a question for us. I think when we look at those, so those are the two main dimensions I worry about, right? To be honest, the specific choices of which model you choose to get the PDs and LGDs is not something I sweat a lot over. I think that's pretty straightforward, right? I mean, most of the models end up in the same place for the same set of data, so I don't think that's a real issue. I think it is the transparency and the dynamic balance sheet aspect. How do we deal with that if we are going to move to top down? Yeah, from my perspective, at least, yeah.
Yeah, in terms of the credit risk and the industry trends, this in particular sector, particularly or significantly impacted going forward the banking industry within the next period in terms of if you have to pick up a specific sector, real estate, consumer.
So I think the most uncertain sector, let me choose it that way, is the household sector. I think we're in a period where post-COVID, the massive policy stimulus has ended, right? So the fancy macroeconomist people will tell you that actually you got a lot more bang for the buck with both monetary and fiscal policy stimulus during a period like the pandemic. Now, that's taken out of the equation, and we're actually raising rates. right? And not only that, it's done at the same time across the globe, more or less, right? All the larger economies are turning the dials away from fiscal stimulus towards more restrictive monetary policy. So this whole period has been very strange, right? It's a very unusual period from 19 and on. How that's going to flow in terms of the policy impact, I think the macro models that we have are not perfect when it comes to that. I also think that the behavioral assumptions of how households behave are a challenge point, right? I mean, are we basically just seeing a period now where households are living off the money they couldn't spend during the pandemic? So we're going to have a delayed consumption decline and demand cooling off? Or is that going to be more of a catch-up effect, right? And I think there's a real uncertainty as to the time profile of that adjustment. The other thing I would say is I think, but this is a general thing on the corporate side, we've again had the stimulus. There's been this kind of artificially keeping everybody alive to not break the structure of the real economy. Again, stimulus has ended, rates are up, outlook is uncertain. Are we going to see a rapid increase in corporate defaults or companies just closing? Right, we're seeing fewer companies being created. We're on a number of jurisdictions actually seeing that the bankruptcy numbers are ticking up and the filings are up. Right, it's still small companies, but the question is, what's the structure of the bankruptcy increase that we're seeing? How much of an impact is it going to have? Right, this is a big area of, I think, both concern and uncertainty as well. So those are my two sort of. This adjustment thing, I don't think anybody has a good answer. You get, and you can see that there are all these different indices that indicate how likely do you think a recession is, right? There's quite a bit of dispersion in those. They're all trending closer to depression or recession seems likely, but there's a lot of disagreement, right? Reflecting that there's this uncertainty about what's happening under the hood of the real economy. Well, how is the engine adjusting? Yeah, is that fair? Thanks.
I'd like to come back to your question about top-down approaches. Looking at what's happening in the US, the Fed is clearly using a top-down approach. But I would say it's based on a pure standardized approach. And the consequence of that is that there is no migration effect at all, because in the standardized credit approach, there is no migration unless there is an external rating that migrates down. And as we know in the US, they are not allowed to use external ratings. In Europe, we are, but there is a very minor share of the portfolio that's been rated anyways. We are kind of in the same situation. So, and you went kind of fast on the slide on the risk exposure amount. This is still 120 or 140 basis points of CET1 deflation, which is quite significant, I would say. So it's a major difference between the US and the European stress tests. So my question is, in a top-down approach, is there a way to keep the internal models and therefore to keep the risk sensitivity on the credit risk side? Or would you be prepared to abandon that risk sensitivity? And probably an additional complexity in my question, and I apologize for that, is how does it fit into the Basel III endgame, I would say, with the output floor? So with banks constrained by the internal models, see some depletion more than the ones that are not that are bound by the output floor. And so are you, as the next exercise will be 2025, so are we maybe based on data and December 2024, so maybe you can still pretend that we are still under Basel 3.0.
Sure.
But that comes pretty fast.
No, I agree. I mean, good question. So let me try, right? So the good news is that the capital requirements, we can always calculate, right? You can take the bank and you say, you tell me, right, for a given bank, right? Let me take a fictitious bank. So a bank is really a set of assets and a set of liabilities. So if I ask you to report, well, please tell me what your assets are and what type of regulatory treatment you have for your portfolio. So say the bank has, I don't know, let's make it simple, 10 portfolios, 5 are on IRB models, 10, the other 5 are on standardized, right? Then I know what capital treatment you'll get, and I can take that into account when I run my models, right? Because I can do the capital requirement ex post, no? And the output floor for all the dislikes and likes in that particular exercise is pretty straightforward, right? I know what it is, right? So calculating the capital requirements is not difficult. For me, I think the big challenge will be, where are the banks going to be in 25 relative to now? If the benefit, quote unquote, of rolling your own and using internal models is not big enough, if the output floor is seen as simply making it unattractive from a cost perspective, in terms of actually doing the modeling, you just say, no, never mind, I'll just go standardized, forget it. I have the new standardized is risk sensitive enough for me. I'm not super keen spending all these people and money on validation and estimating and whatnot. So I'm just going to go standardized, right? So the question is, where will the banks choose to be? Is the big uncertainty for me. I think in terms of technology, I think we can, if we can find a way to reflect the portfolio heterogeneity across the European banks. I mean, again, it is sizable, no? Both on the asset side and the liability side. Then I'm pretty sure I can handle the standardized advanced modeling mix in the books without much ado. But I do need to cover both, right? So this is the price I pay for running top down. I need to basically be able to run a full standardized stress test and a full advanced stress test to make sense of it, right? So it's not going to be easy. So basically, I need both technologies in place to be able to do the right mix for each bank, in addition to the heterogeneity in terms of, again, households, how many buckets do you have, whatnot, right? What might make it easier, sort of practically speaking, is that if I go further along the regulatory cut in the portfolio, it should be easier for the banks to talk to me and give us data and do something that makes sense, right? It'll be easier for us as well. So I think part of it is also reflecting on the 2 steps in the exercise, right? So I think it's doable, but you're absolutely right. It will be very important to do it in a way that's credible. Because if we don't do that, playing by the output floor and by the new standardized and by the probably changing weight, or I expect away from being advanced in certain areas, right? I have FRTB as well, right? Which is, it's a big change in that space. It remains to be seen what the banks will do. But I mean, technologically, I think that second step is less difficult than the first. Yeah. But I agree. Point taken. This is part of the challenge. As you can hear, we are. It's up on the wall, right? How do we handle in 25 the fact that we will pretty much be live with, and as of yet unfinalized Basel III package, right? Yeah. I mean, Europe is not done. It hasn't been signed off, right? Allegedly there's a compromise, but it hasn't been written up. We haven't seen the text. Yeah. So there's still some work to be done. Sure, they'll get it done, but it's not done yet, right? So there is not much time to get the technology up and running. But I'm, again, giving my past life, having run this for a couple of large banks with the full bells and whistles, it's doable, right? It's not impossible, but it needs to take care to get the portfolios rightly allocated into the buckets and do the output flow calculation and stuff like this. But okay.
Prioritization.
by jurisdiction, by portfolio, right?
No,
Because
the stress test have never been at solo level.
No, and that's the thing, right? But the fact is also that the jurisdiction view is probably outdated, right? The more we get into having European banks that are active in several countries, a jurisdictional view doesn't work. Right? So if I have big banks that are across Europe, I need to reflect that, that those banks will have French mortgages, Spanish mortgages, German mortgages, maybe for rich and poor people mortgages, right? But it increases the number of portfolios that each bank contains. So I can't use a jurisdictional review much longer if I want to treat, I don't know, let's pick on German mortgages, right? If I want to give German mortgages the same treatment across all banks, I need a model for German mortgages. I don't need a model for BNP or Santander. I need a model for German mortgages that makes sense, right? So part of my challenge is if I'm to build a setup for the future, I need to build a setup that can actually handle a banking union, that although slow moving is gradually happening on the ground, right? And this is a little bit, I think, also my challenge with the competent authorities. We're having that conversation. How do we best do that to maintain a reasonable degree of reflectiveness of the risk profile, right?
Check on more globally on Basel III. Would you answer to people that would say that the results of the stress test don't demonstrate quite clearly the need for further capital requirements, and why is there still a need for going more into demanding and other layers of capital?
So there's two responses to that, right? The main response is, look, banks are pretty much Basel III compliant minus by 10%, right? It's not a lot that's left. So the extra that comes with finalizing it is not that big a deal in actual numbers, right? The other thing is, right now, banks have been sort of shadow boxing against a set of rules that have not been finalized and are trying to adjust. So hopefully by clarifying, establishing that those are not the rules, that'll make it a bit easier on the banks and also on the supervisors, to be frank, to figure out what then is the playing field here, right? But I don't think that the last step in the process is really not the key. The key is that the banks have already been told to have more capital. And it's probably better to do it in a way where the rules are clear than giving it as full discretion to the supervisors. I think there's a balancing act here. I know if I were in a bank, I would like some rules and then some degree of discretion on the supervisory side in a reasonable mix, right? And I think the finalization is really just making that last leg. It's the end of the journey, not the beginning, right? That's sort of so as a former BIS staffer, for me, Basel III was done in February 2011, right? I distinctly remember we had a glass of champagne and said, thank you. Now over to you people, right? That was February 2011 post-crisis. Here we are, 2000? Don't tell anyone, right? I mean, it's taken long enough, right? But that's always been the case, right? Basel III has been a little bit longer, I think, in terms of implementation, but sort of around a decade from birth to actually being in the rule books. That's where we are, right? So most of the adjustment has taken place, right? Again, Emerald bond issuance, what are we missing? 0.2%, right? I mean, it's 99.8% done that banks now have bail-inable bonds out there. The capital requirements are pretty much there. And I think if you look at our quantitative impact studies, ours, the commissions, the Basel committees, it's mostly done. There's a handful of banks left. I think we're not there. Pretty much every bank in Europe is there, more or less, right? Again.
But banks are there in terms of capital amounts.
Yeah.
And as BIS and your studies, you're always looking at the requirements. I'm going to say minimum requirements are 4.5. It's actually like 9, 10 or more. Or acronyms like OCR, TS, total sweat, CR, or whatever like this. So it's much less transparent, I would say, than the 4.5%. very nice minimum requirements, whereby everything on top of it is there for full process. We're not in that space in Europe. This is a different debate, but suppose, so seen from this 9-10%, of course, banks are there. So the key question is not, yes, it's to which extent we banks be able to reduce their nominal capital ratio, keeping, of course, the same or even a higher level of the capital amount, with
more than the other half, basically. So I think here, I look at it at least as much as a challenge on getting a debate about the macro prudential rules of the game across Europe and getting some alignment and maybe common methodology in how you approach that, right? Because I think the micro prudential is probably better aligned across Europe. So here, that is what it is. The views on the levels is a separate exercise, right? But the alignment is there. The macroprudential side, I think, is more of a challenge in terms of alignment and getting less ambiguity. Let's call it right.
Yeah, but that's why I was not even speaking about the buffers.
Yeah.
I was speaking on the roof of a new road.
No, I think.
PSTR, OCR, which I'm really interested
But all of that is that element of supervisory discretion, right? I wouldn't hold my breath in terms of that being taken away. I think that's probably necessary with very different banks, complicated, medium-sized, small banks. So there has to be some supervisory discretion left on the table, right? Or else the system isn't going to work. We can debate how much, right? My sense is that when Basel III gets finalized and the dust settles and the European flavor of it is there, it should be a little bit less unclear compared to today, right? So I see the challenge more in the macro policy space, or the macro prudential areas, to be honest, right? I mean, that's sort of my take here. That where do you end up? Well, a good chunk of the buffer debate is a little bit less, I put it politely, well established across Europe in terms of how you play it, right? And this is a national issue. And there are very different views, right? You've got Dutch who are very conservative, you've got others who are a lot less conservative, right? Again, that's a political debate that I can't have, right? This is somebody needs to change the rules of the game here for that to change. But, you know, again, in terms of ambiguity and quote unquote level playing field, I think there's more meat on the bone there than on the Basel III, right? Again, we'll see. if you look at the US playbook is out, right? Their final report is out, right? I mean, the distance seems not huge, as best I can tell, between Europe and the US, right? Which is a positive, I think. That sets the tone for a good number of other jurisdictions. So I'm more optimistic on the micro-proof side in terms of reasonable alignment, also globally, right? The green space, less clear that we'll have alignment. I think there's more disagreement in what you should expect in terms of reporting requirements and transparency, right? My sense is that the UK, the US, Canada is a little bit less willing to push for additional disclosures, right? We'll see, yeah. So that's another area where there's a bit of a, let's say, nuance. Thanks.
Are you going to organize yourself a forum to get feedback, sort of post-mortem of this exercise?
Yes.
Here it's
No, yes. I mean, yes, we are. We're gonna find a way to get some more organized feedback, right? So my hope is that we can have a conversation where we tell you what we think, and then you can tell us what you think from industry and others, right? So the answer is yes. I've got my list ready. So I just need to find the time in the calendar when we can have the conversation, right? But yes, there's an intent to do that. There's also an intention to have some conversations about top-down, how to approach and what the concerns are. Right?
Side of the Fed, did you see a change of attitude or expectation regarding the nature of the dialogue with you following the mess they had to go through? Why am I raising this question? Is my understanding is somehow what happened in the US was kind of a stress test for the EU. And we went through obviously not so badly. So from the outcome, you can say, well, this means there's a good practice in the EU, a good model, and blah, blah. So if it changed the nature of the relation with the Fed or not?
I mean, I must say, what I've seen, I thought the Fed did a pretty admirable job at summing up and acknowledging the weaknesses and imperfections of what they did. And they presented a pretty coherent set of responses. No? I mean, I think there was this immediate, well, what do you think? What are you going to do? What are you going to do? And the Fed said, can you just hold on, give us a chance to get our bearings? I thought, I can't remember there was a name on the report. I'm bad with names, but they sent out a pretty decent report. And I think the conversations we've had also at the Basel table, so my perception has been pretty clean, right? It hasn't been duck and cover, if I can use that phrase. It's been pretty open, say, look, here's what we take away. And my sense is that some of the themes that we also talked about now, right? The handling of amortized cost holdings or also maturity bonds, who should be subject to what rules, how do we look at the liquidity risk lessons, not so much from Silicon Valley Bank and First Republic and the others, but from Credit Suisse, right? I think honestly, the conversation has been more around the Credit Suisse, sort of that was a very rapid withdrawal, right? For a very large bank. So that's more of a concern, I think, right? But the debate about how do we approach the liquidity risk aspect, is there, right? I mean, I don't think people have an answer, but for sure the supervisors across the advanced economies are pretty busily engaging with the banks and asking them pointed questions. You know, well, your corporate deposits, how robust are they? What if I did a more aggressive LCR? What would the time be before you hit the deck? So there is a constructive debate with the banks on this, to my understanding, right? So the same themes, the other theme that's out there, which is being discussed, is the interest rate risk and the banking book approach, right? Where in Europe we're discussing, maybe having a few more scenarios on the decks to get some more extreme numbers. I think the Fed's having the same debate with their banks. I know they've asked them. So I think the response is, the focus quickly centered on some of these liquidity aspects, the possible need to update the rules, but I mean, to change the LCR package is not, I mean, again, the LCR package in concept is simple, but it's 150 pages of text, right? So if you want to modify and update and address it, it's going to take some time to do that at an international level. I think right now the conversation is between supervisors, right? That's the first line of defense. The other challenge point, but that's more of an intra-European thing, post-Credit Suisse, has been, okay, the Fed used the deposit insurance mechanism. No, and that's a hugely politically difficult topic in Europe, right? I know. But that comes home to Europe and you say, okay, that worked in the US. We don't really have the same tool. The other thing that the Swiss did was the resolution, where they moved very, very quickly, right? I mean, respect to the Swiss authorities for moving at super speed over a weekend. Would we be able to do that in Europe? Are we ready for that? Again, I think people have their doubts, right? So I think there's also some intra, the lessons for Europe in terms of the EU setup. Are we ready, right? And I think that was maybe more. That has been more of a debate. I think that's been more of a sort of a concern, right? So I'm not sure I see at least from my vantage point, that what I've listened to and seen from the Fed, the conversations I've been part of, it hasn't been complicated. If I can put it like that, yeah.
Could you say a word, Jacob, on climate risk, which was not considered here, but said will be
Sure.
the subject of a Fit for 55 scenario analysis?
So we're doing this Fit for 55 analysis together with the other ESAs and the ECB and the ECB. So the exercise is one to take the whole financial sector, right? Do ESAs. We do some work with ECB to try and get a full financial sector impression on what will it mean if we take sort of I think the debate we're having now is some sort of adverse scenario that is negative on brown assets, so to speak, right? So a critical scenario on parts of the book to see what that will mean for IOPA, ESMA, and EBA clients, if I can use that phrase. So we just had a conversation yesterday at the ESRB Advisory Technical Committee on the sort of a first cut on the scenarios. So the scenario debate is ongoing. Here again, I would say a somewhat humble ambition level in terms of granularity, in terms of what you can do, right? I mean, I don't think the system nor the data is available to do much more than NAICS Code 2 level detail. Maybe we can feed in specific asset class information and do certain things, but that's sort of where we are. The debate we're having is, I think, realistically an 8 to 10 year time horizon. And we're having a consultation on data collection pretty soon, right, with industry. So there'll be, I think, more clarity as to what's expected to fill in the numbers that we need to run the exercise.
So you're saying the scenario will be the same for bank, insurance, and other financial institutions, yeah?
Yeah, that's the whole point, yeah.
Okay.
So technology will be a little bit different across the industries, because that's just, I think, the nature of the game, right? If you're an insurance company, it looks different from being a bank. If you're a fund or market-driven business, it's different, right? But that's sort of where we're headed. I think we're on track, right? I think we'll have a good conversation then next week, I think, yeah. Next week or the following week, there'll be an industry meet. I'm sure we'll have more conversations following that, but so far so good, right? I mean, Is it going to be only a stress? I'm not so sure. I think it's going to be more in the spirit of a transition risk analysis than sort of a classic prudential stress test, right? Because it isn't really about prudential. I think it's more about the changing risk profile of the balance sheets and what that means. So it's going to have a slightly different flavor, and it's a slightly different set of questions than what you do in sort of a standardized prudential stress test. Yeah, so it's going to be a little bit broader in the way it's laid out. Yeah, yeah. On the scenario, I should say we are of course aware that the NGFS scenarios will be updated later this year, so that will be reflected in the scenarios. Right, it'll be the new, quote unquote, the new breed of NGFS scenarios that we'll rely on. At least it will be reflective of that. Yeah.
Okay.
Yeah. Is that?
You mentioned a consultation to the industry that has been launched already.
Yeah. Yes.
Okay. And which will be about.
It's about there'll be an ad hoc data collection to fill in the needs for the exercise. Yeah. So that'll happen soon. Right? So.
Good.
Hope to see you there. Exactly.
We're getting to the end. Are there any other questions? No. Jacob, thanks. Thanks very much for this open presentation, clear presentation, and invitation to strengthening the dialogue with banks.
My pleasure.
And we'll be
Thanks for
working with that.
questions. Not all of them easy, but it's always good to get some hard questions. Yeah.
Okay, good. Thanks very much. Thanks for